In this video, I'm going to talk about 5 factors that Canadian banks looks at when they approve your mortgage. Hi, my name is Ahmed Mahian, and if you are new to this channel, I'm a certified financial planner both in Canada and US, and in this channel, I talk about personal finance stuff. So whenever you are applying for a loan or a mortgage, banks typically have a set of guidelines that they use to approve your mortgage or any kind of loan. These guidelines are typically referred as 5 C's of credit. So what are those 5 C's? These are credit score, capacity, collateral, capital, and character. Let's take a look at how credit score impact your mortgage application. So we all know that credit score is one of the most important factors whenever you are applying for any kind of loan. Now in Canada, there are 2 credit bureau company that generates your credit score. So those companies are Equifax and Transunion. So whenever you are applying for a mortgage or any kind of loan to a bank, typically your banking institution or financial institution will request a report from one of these credit bureau company, and those company will give a score based on whatever you have in your past history. So these credit bureaus companies have your financial records of your credit activities. For example, if you have a credit card or if you have a line of credit, or you might have a car loan or maybe a mortgage. So all of your data is actually reported to these 2 credit bureau company, and these 2 credit bureau company analyzes those data, update those data every month, and then generates a score, and that score is actually used for your mortgage application. For example, I might have 700 score from Equifax, so that will be the number that the bank will use whenever I'm applying for a mortgage or any loan application. Now, sometimes if you are working with one of the banks which provides free score, you can request a copy from them. But remember, those reports are free copy, and often they're not the same as the one that the lender use when you are applying for a loan application. So the loan application credit score is going to be up to date and often more accurate compared to your free score, because the free score, when you pull it from your credit bureau, they are actually not pretty accurate, and you cannot use it for a mortgage application or any kind of loan application. However, the free score will give you a guideline of where do you stand in terms of your credit score. Now, what is the minimum score to get a mortgage approved? Now, different lenders use different score. In general, to qualify for an A category mortgage, you need to have at least 680 to qualify for a mortgage. Now, some lenders use a lower score than that, but that mortgage application will be a little bit different because you are categorized as high risk taker, and you might have to pay a little bit more interest because your score is not high, and that's why the bank is going to charge you a little bit more. But if you have 680 or above, or maybe 700 plus, you probably will qualify for the best mortgage product. Now let's take a look at what capacity to borrow means. So the second factor the banks use is how much money you are making. This is a big factor because Canadian banks typically are income-based lender, and they often look at your household income to qualify for any kind of mortgage application. Now, if you have a spouse, you want to add that spouse to the mortgage, then you can combine those income, and that will give you more capacity to borrow. Now, based on your income, the banks typically calculate 2 of the ratio, which are called GDS and TDS ratio. Now, GDS stands for gross debt service, and TDS stands for total debt service. Basically, GDS is capturing whatever expense that you will have which is related to the house or the property you are buying, whereas is capturing everything that you have to pay. So it includes your mortgage payment, it includes all the payments related to your house, plus it's adding more liability that you have. For example, you might have a car loan or you might have a student loan. So all of this loan goes to the TDS. So TDS includes both GDS and your other loan liabilities. Now from the screen, you can see the formula for GDS, which is basically takes into account your mortgage payment that includes your principal and your interest payment. You also have property tax. You also need to include your heating bill to this GDS calculation. Now, if you are buying a condo, then 50% of the condo fee is also included in the GDS calculation. Now, let's take a look at the formula for the TDS. So you can see GDS already is included in the TDS calculation, plus it also adds your credit card payment, your other home loan, your other auto loan, your other obligation. For example, some people have child support or spousal support. That also needs to be added into the TDS calculation. Whenever you're buying a property with less than 20% down payment, you need to buy a CMHC insurance. So if you're buying a property which is less than $1 million, you need to buy CMHC insurance. Then your GDS and TDS calculation needs to be under certain limit. For example, I'm recording this video in February 2024. So as of today, the CMHC guideline for TDS and GDS is 44 and 39. What that means is if you are buying a property which is under CMHC insurance, then your GDS and TDS calculation cannot be more than the guideline. So which is for GDS, it's 39. And for TDS, it's 44 in the early 2024. Now, it used to be less than that. When I first started in the banking industry 8 years ago, it used to be 32 GDS, 39 TDS. But as the mortgage and cost of living and the house price has gone through the roof, these numbers have been adjusted and CMHC has increased that GDS, TDS threshold. And right now it's sitting at 39 GDS and 44 TDS. Now, if the mortgage is not a CMHC insured, then the bank sometimes uses a different GDS TDS number. But again, different bank uses different numbers, but they typically do not exceed 50%. If they exceed 50%, those are special program where you have to have lots of net worth or lots of business with that particular bank so that they feel comfortable that you are going to pay back their mortgage. But in general, 3944 GDS TDS is the standard guideline. Now, the third factors that the bank use is collateral. So when I say collateral, it means that what kind of property do you have and what market that property located. So basically what the bank wants to know is how quickly they can sell the property if you are not able to pay their mortgage back. So if the property is located in a hot market like GTA or Greater Vancouver area, it's very easy for the banks to sell and recoup their mortgage back. But if the property is located in a rural area, which may take few months or sometimes years to sell, then the banks will typically ask for more down payment before they approve any loan. And sometimes some of the banks don't even bother approving a mortgage if the property is located in a rural area. So you have to figure out which banks are going to lend you depending on the geographical location of the property. Each bank uses different guideline to calculate this, but in general, if it's a bigger city, then it's typically not a problem in terms of collateral. And also sometimes the bank also look at how well maintained the property is, because when they do the appraisal, they're going to see if the property is going to last over the course of the mortgage life cycle. If the house is in a bad shape, sometimes the mortgage company or the banks don't lend that much money because they know that the property is already wrecked and they probably will not be able to sell it to a new buyer to recoup that fund. That is collateral of the loan. The fourth factor is how much net worth you have, or it's called capital. So what that means is the bank will look at your life stage and try to figure out if your income makes sense in terms of your net worth. So for example, you might be a millennial person who just got out of the university and you're making good money. So presumably at your age, you probably don't have too much assets, and the banks understand that. But somebody who is in their 60s and they had great income over the years, but they don't have that much assets, that is basically giving a negative signals to the bank where they can come back and say, hey, hold on a second, you made great income, but how come you don't have that much net worth? Whenever you are applying for a mortgage application or any kind of loan application, they will always look at how much assets you have and how much liabilities you have. Asset minus liability, that is your net worth. When banks look at your situation, they try to figure out, okay, is that net worth making sense based on the person's life stage? So in general, the more net worth you have, the probability of getting your mortgage approved is typically higher. And some banks even have high net worth mortgage program where you don't have to have enough income. If you have enough assets, sometimes you can pledge those assets to get mortgage. This is very typical in the high net worth banking relationship where a high net worth person might have millions of dollars with the banks, and typically the private banker will lend a mortgage to that high net worth individual based on how much investment that person has with that bank. And sometimes these business owners don't even show that much income, but because they have such high amount of assets, with the bank feels pretty comfortable that these business owner will pay back their mortgage. And sometimes they can even have one of those investment portfolio as collateral for the mortgage. If you don't have enough high net worth, don't worry, then you have to compensate that lacking with your high income. And the last step is character. So when I say character, what I mean by that is banks try to understand your job stability, how marketable you are in terms of your career. They also look at how frequently you move from one city to another. That gives an idea of residential stability. And sometimes they also look at money management or honesty. So if somebody commits a fraud, then typically banks is not going to like that and they probably will decline. So all of this goes into character. But the main part is basically they want to see how stable your career is. So if you are in a job field where you have lots of demand, you probably have very stable career. If you lose your job in one day, you probably will be hired within a month. Then the banks feels pretty comfortable lending you money. But if you're in a field where it's very seasonal and there are lots of layoffs every year and it's very difficult to get a new job, then typically banks will not like those things and they may come back and say, hey, we probably need a co-borrower or we probably won't lend you any money. These are the 5 factors that all the big banks look at whenever they are approving any mortgage or loan application. Now, each lender has their own policy, and some lenders will be more lenient in one of these factors than the other factors. Each bank, sometimes they are okay with low score, credit score, or maybe they are okay with low income. As I said, typically when you are shopping around for any mortgage, you will probably see 3 types of lenders. A-type lenders, so this is your prime lenders. Whenever you are going for a big banks, you meet with your advisor at a branch. That is basically your A-type mortgage. You have to have high income, high credit score to qualify for those mortgage. Now, the second type of lending you will see is B lender, or also known as alternative lender. Basically, these are lender who are a little bit more lenient in terms of credit score. So they might approve a mortgage application where the borrower has a little bit of bad credit. Maybe they don't have 700 credit score, they may have 650 credit score, or their income might be a little bit low. Their GDS TDS might be, let's say, 5% higher than the guideline, or they might have a history of where they didn't pay credit card bills because they had a bad divorce. So all of these factors can make your application worse, and you may not qualify for an A-type lender. In that case, you might have to shop around to a B-type lender or alternative lender. Now, when you shop around, you will see some banks have both A and B type lending. So some of the banks, especially the monolines, they have both A side and B side. So what that means is they will look at your application and tell you exactly if you qualify under their prime guideline or their alternative guideline. So if you go for an alternative guideline, then they will charge you a little bit higher interest rate because definitely your mortgage application is not strong enough, and that's why you have more risk to the bank, and typically they compensate that with charging higher interest rate. Now there is third type of lender, which is private lending, which I covered in details in a separate video. If you want to check that out, be sure to check this video. But basically, those borrowers who don't have great income, don't have great credit score, they typically borrow short-term mortgage from private lending. And private lenders, they don't have any guideline because that's a unregulated market. The government don't have too much regulation in that market, even though they are trying to implement, because a lot of lawsuit is happening in the private mortgage market, because when the market was crazy back in 2021, lots of shady stuff happened, especially in the private mortgage market, and those are unfolding right now as house price dropped. People are not being able to pay 10-15% mortgage rate. So a lot of lawsuits are happening in that space. But as I said, each lender has their own policy, so they might be strict on one of these five factors, but might be a little bit loose on two of the other factors. You might want to work with a mortgage broker. I was a former mortgage broker. I was mortgage broker for a couple of years before I gave up my license because I was too busy with investment, tax, those kind of work. I couldn't manage enough time. My wife is a mortgage broker now, and she takes care of the mortgage side of my clients. The great thing about mortgage broker is when you work with a mortgage broker, they typically have access to 10-15 lenders, and each lenders might have different policy for different types of loan. And a mortgage broker can shop around based on your personal situation. So you get approved for your desired mortgage and they get compensated by the bank. Mortgage broker for A-type mortgage, you do not have to pay anything to the mortgage broker because the mortgage brokers are paid by the big banks. But if you are going for alternative or B lending, then there might be some separate fee, but typically they're required to disclose upfront. And if you are going for a private mortgage, then yes, there is a brokerage fee, but those fees will be discussed upfront. If you have immaculate numbers in terms of your income and credit score, then you can also apply for a prime mortgage. Basically, those will be the lowest interest rate from the bank. So if you are working with just one bank, let's say you work at Bank 1 and you are meeting their financial advisor, that financial advisor or mortgage specialist can only talk about one bank's product, but a mortgage broker can talk about 5 different banks' product. So I highly recommend you checking out and talk to your local mortgage broker who you trust and try to see the best available rate that you can get in the market. So that's it. That's all the factors that banks use when they are approving your mortgage. If you have any question, please let us know in the comment section. Thank you so much for watching this video. If you like this video, please subscribe to our channel, like this video. It will help us to grow our channel. And if you want us to cover any specific topic in the future, make sure to reach out to us and we will try to make videos on those topics. Thank you again and see you in the next video.